budding researchers like us. So please may I start with you first.
ครับสวัสดีครับ Thank for having me to this panel and thank for the introduction. Thank for the disclaimer as well. So what we have been doing to support research in this field, particularly for the market microstructure, right? So let me introduce about something we have been doing. Maybe click here. Okay. First of all, we've been position our team, the SET Research, as an enabler in the capital market research. You have heard Ajahn Wasin present his work that we work in collaboration with his team as well. We've been providing the regular update about the market insight, monthly report, and some survey, some indicator. We've been providing some short article about key issues in the market. It's a quite short article. We've been support research in capital market. This year we support student scholarship on a few topics in capital market research like the ESG, like the market quality, and this year for the professor or faculty member we support scholarship on family business in Thailand. This might be something more relevant to this seminar. We also facilitate or support research in capital market by providing the database about capital market. Ajahn Wasin has already shown to you how he developed the access to the market microstructure database. That is one of the database we've been provided. Aside from that, we provide the market data through the Asset Smart, the corporate governance database, the international exposure of listed company, dividend universe, some industry indicator, and the factor library that has been developed by Ajahn Kanis that help you guys do the research in asset pricing, the factor models things. So for the market microstructure, you already heard Ajahn Wasin talk about that. That is about something about how the trade taking place, the interaction of the market participant. Right? And right now we have 10 formal collaboration with the academic institute to use this database. It consists of the deal file, how the trade execute, and the order file, bid ask, and or the order book in the market. So if you want to do the academic work, we can support you with this funding and database. So this is some example that by having this database, you may be able to answer these questions about price discovery, about the market design, about the transparency in the market, liquidity, volatility in the market. That a few examples of the research topic in the market microstructure. So I think this is for the first round, how we support the research in this field.
Thank you so much. As you can see, data support and also funding support as well. So for those of us students in the room, if you're interested, please talk to your professor because these kind of opportunities are typically circulated to the academic departments. And if you have research that you do, maybe for your master thesis, for example, and you're interested in taking this further, these opportunities are always open for students in Thailand. So next, I would like to invite Khun Pongpit to talk a little bit about what work does the research team at SEC do, and today is about market microstructure as well. Is there anything you're working on market microstructure specifically in the recent days?
Okay, thank you. Thank you for having me, and I would like to say that it's an honor to be part of the discussion. I would like to say about, with my background in financial regulation and public policy researcher, so I have a great opportunity to monitor the development of the market, especially the rise of the algorithmic trading in Thailand. We, SEC of Thailand, conduct the market research, the policy research to support the management, decision. I would like to show some of the selected paper that we bring on the PowerPoint. We try to answer the basic question that what are the basic patterns of the algorithmic trading in Thailand? By literature review, by business journal review, the algorithmic trading in Thailand can be grouped into at least two broad types. The first one, the execution algo, and the second one, the profit-seeking algorithm. For the execution algo, as its name mentioned, the purpose of the execution is not money-making, but it's try to send the order more effectively to reduce cost and minimize the impact to the market. This we call the execution algorithm. The second one, it is the profit-seeking algorithm. As its name said, this type of algorithm try to make money from market opportunity. There are a lot of subcategories for the profit-seeking algorithm. I would like to say that the algorithmic trading is not the trading strategy by itself. It's just a technology that supports traders to send the order or construct the trading strategy and send it to the market. The next one, this is our analysis from our policy research. We conduct the research based on a million of transactions of the actual trading activity in Thailand, and we try to categorize the pattern of the traders. I would like to show that for the left-hand side, there is a number of trading days ranging from the 1 day to 250 days. And on the right-hand side, it is the absolute net position, which means the position held overnight. You can see that almost all of the account trade in Thailand held position overnight and do not have much trading activity. As a result, we could imply that this kind of traders are the execution algorithm trader. But on the other hand, if you look at the top on the left-hand side, this position trade almost every day and not hold position overnight. So this kind of trader could be the profit-seeking algorithm traders. And on the top of that, some of them would be the high-frequency trader. That's what we extract from the trading activity, and we try to classify the pattern into at least two groups. And with different type of strategy, they have different impact to the market. In general, the execution algorithm, it is just minimize the trading costs, minimize the market impact. In general, it has no harm to the market. But for the profit-seeking algorithm, sometimes the algorithm could play a little bit harm to the market. That's all what we found in the Thai market. Yeah.
Thank you. So that's a good opener. And we already heard from Khun Vithan in the earlier sessions that there are many trading strategies available. The position that we saw is probably directional, non-directional trading strategies that we heard in the previous session. So having seen the data that the SEC shows, from your experience in the market, what kind of trading strategies employed by the new generation of trading algorithms and so on, do you think are most common in Thailand at the moment?
All right, so I really like your presentation, so please turn it on. We could make use of that too. And basically, let's classify by the asset class first, because it's totally different for the algos for set 50 futures and for the stock tradings. Like, could you change it, this slide? Because it's shown here in the data. Thank you very much.
You need a pointer?
Yes, please. Okay. Is this working? Pointer? A little bit. really small. Yeah. All right. So okay, thank you. So basically, if you notice from the colors, the blue one is the local individual, which represent retail trader, right? And the x-axis is the absolute net position, and the y-axis is number of their tradings. You can see that most of the time they are not that high frequency traders. They trade lowers, but there's still numbers of them. So most of retail traders, they do the kind of scanning. So we call it plug-in hybrid strategy. They're scanning by fundamentals, and then they use the technical to detect the momentum, detect the trend, like price opening and like jump and have like 5% gap, something like that. That very famous in the market right before the market crash. So, but nowadays the bot is more like that I see is more like tilt toward fundamental. So that's why the from this chart is more in the rear right. It's in the bottom, right? But for the futures, say any futures market, most mean reversal strategies, which in retails we call it grid trading. They just identify the key resistance level and key support level, and then they just do the let's say press a bit, just doing that. And it's getting famous because many KOL say finfluencer and say the algos from MT5 is popular in Thailand.
That's an interesting idea. I know we didn't talk about this when we prepare for this panel discussion, but you brought up a very important point about finfluencers and also trading strategies. Okay, you've been in this area for a long time, and 13 years ago, I don't think there were any finfluencers, teaching people how to trade. Can I get your impression on your experience seeing that, and maybe your reaction as a professional and also trader with experience? What your views are on how easy it is to become like a finfluencer doing this nowadays?
All right. So basically, I'm also one of the finfluencer in the past, but I'm on the VI side. I've been in finfluencer business since 2015-16. We have Phenomena first, and then personally my brand as bottom liner, and then Investic later on, like 5 years ago or 4 years ago. So I would say it's easy. You just get in your Facebook, social media, and you just post something that day. But to gain followers, it's not easy. So the influencer that you see nowadays, they put a lot of effort to say learning, research, and give away to people. So at that time, back then, like 10 years ago, I do it because my passion. I didn't do it for business. But then later on, you notice from bottom liner, I rarely post something because even I post, the algorithm didn't favor me, right? They want the algorithm force the influencer to have engaged, to do something, to have call to action, to get some engagement. And this combined with the say commercial benefits from being influencer. The easiest way, this is just my personal view, right? The easiest way to gain followers is to show your profits. And the easy one is to use bot that trades a lot, and you delete all the red one. And then you show it to clients. That is what's happening in the market.
That's precisely what we call selection bias in
Selection
academia,
bias.
right?
Yeah,
You're always going to be able to find a profitable trade because I have 100 other positions didn't make any money, and then you use that too.
And it's called as more than selection trade because it's more like selection post.
Yeah. I want to show you what I want to show you. That's it. And, So we'll probably come back to this point again about democratization of trading ideas versus what are the benefits for you to innovate and find new research. You already mentioned Ed Thorpe that he came up with the Black-Scholes model, but I think the legend goes that he doesn't want to come out with it because he wants to be a billionaire instead of Nobel Prize winner. So he decides to do that instead. So we come back and talk about role of academia later on in the moment. But before we go down that route, I think we're now in the case study, okay, that we saw today, set up by Rodman. Eric mentioned about one of the parameters of the cases that we're not. We're going to have a possibility of you perhaps front-running the orders, and then the system's going to penalize you, okay, for front-running. So I want to use this opportunity to talk a little bit about the kind of conduct, okay, in the profession. That what are the things that the profession and perhaps even the regulators as well find acceptable, okay, versus find a little bit shaky on the gray line. So if I may ask Khun Pongpit to talk a little bit about the rationales behind why certain actions like front running we talked about earlier on are deemed unacceptable, and what are the lines typically?
Okay, first of all, I would like to emphasize that the algo trading or the high frequency trading is not the trading strategy by itself. So if the strategy is manipulative, it's wrong, whether it's sent by the human or sent by the algorithm, right? So the front running or spoofing or other kind of manipulative behaviors is wrong, even done by the human or the man.
So may I ask a little bit about front running and spoofing that you mentioned? What does it look like typically? We have to compare this to maybe non-market trading, normal business. What might those activities look like?
Okay, it's about the friction in the market, right? Because the guy who did front running may take advantage of some insider information or information from your customer to make the order before the customer, right? So it's wrong in professional manner, right? For the spoofing, it become quite popular since the IOSCO, the International Organization of Security Commission, published the paper maybe 10 years ago. The IOSCO paper in 2013 said that because of the advance of technology that could amplify some manipulative behavior, and IOSCO give two examples. The first one, the spoofing, and the second one is marking the close. For the spoofing, it is, in general, it is the fake order. It's order which have no intention to execute in the market, so that might make the confusion to other players in the market. That's why spoofing is not appropriate, or in some country, it is illegal for trading activities.
So I remember in the earlier session, Vithan kind of talks a little bit about this, right? You see the order on the screen, and then you didn't know that the liquidity available is actually not available anymore when you trade as a trader. So is that like an example of a spoofing that you mentioned?
Yeah, I got another example, which is it's more related to those who. Is this recorded? It's just we'll say when I will talk like this, like a dealer playing game, like because the spoofing, one of the reason for the spoofing is that when the market making team, say a team working, they cannot really call your team and say, hey, I put this order. Sometimes they just send like a more signal via the spoofing. They just throw like 100, something like that, or
so, you're like they're communicating, because maybe let's put this into maybe non-trading context. Yeah. Perhaps in certain parts of the economy, we have like arrangements to make sure that people don't communicate to collude, like price fixing and so on. Yeah. So if you take an example like airlines industry, food industry, you have an oligopolistic, only very few players in the market. Regulators are worried that they might end up colluding, agreeing to charge high price to customers, and that's bad for customers. Is this a little bit like that as well?
Yes, that one too.
Okay, so they're not really supposed to be able to communicate directly. So you're saying that some of the orders they send in and then they take out, it's not really to fool the market, but it's really them like sending a Morse code to one another. Hey, by the way, this is what's happening.
Yeah, that is also happening. Both is happening both.
Okay, I see. I think I wanna keep on the point about these market conducts, because these are the things that academic researchers, okay, we don't really see a lot of this, because this is what happened in the field, okay, on a trading pit. These are like, the intricacies of market microstructures. In your talk, you mentioned, they're bot killers. Okay, when you run a bot, they're bot killers. Can you talk a little bit more about what bot killers exactly mean, and what is exactly being done so that when you run bots and so on, you get killed by all these algorithms?
Say that it will often happens when it's not that much active out, say like the overnight session, something like that. And that time, without the major players from the retails, from the institutions, it's all the bot tradings. So things will always go sideways. Most of the time it will go sideways, just swing around. And then there will be some algo traders that deploy the momentum following strategy or trend following strategy, sorry. And sometimes the bot killer will just spark, ignite the price, make it look like it's going to go up a lot. And then those who deploy the trend following bot will jump in, right? Because it hit the criteria, they'll jump in. And then suddenly that time, the bot killer, it will wipe out all the order and sell.
So can
So
I
it's
see
going
it
down.
like this, like there are algorithms everywhere scanning the order book to see what's going on at the moment. So if there's like no big movements, then it's business as usual. Maybe one type of algorithms dominate, like market making algorithms. I just post the bids, I just post the quotes, provide liquidity to the market. But when suddenly you start seeing some movements in the market, maybe another type of bots detect that, and then they think, oh, something big is happening. Maybe there is some news that we don't know, but somebody puts in a trade first, and that kind of
like
tricks the bot into.
Trick the bot into that, and the liquidity that's happening there is all there. So it's all fake.
Okay, like the order standing in showing interest is really not really there, but they also want to kind of trick people into thinking the market is moving one way or the other.
Exactly. And that's happened a lot in the gold market.
Yeah, okay. So I don't think I want to ask about regulation because it's a bit too much to talk about today. But from the trader perspective, you mentioned that this is happening in the market, right? So that means other traders are aware that this thing can happen as well, like being tricked by other bots. What do traders typically do to protect themselves against being fooled by other bots as well?
Well, actually, most of the they just failed and get out of the market. But those who survive they will have to develop like the AI to detect the false signal. But it's simply very hard because I did it too, and say even now the accuracy I got is less than 70%.
That's why you mentioned you go for a lower frequency strategy
That's
now,
right.
directional and all that stuff. Okay, so thank you. So I think one of the things that we probably see in the past few years is that there are lots of challenges going on in the market from the fundamental level and also from the trading infrastructures level as well. I think Khun Chatchai, you've probably been at the center of discussions about all that, and what can we learn about what's going on from the market provider about how to adapt to the challenging landscape of modern trading and everything else as well?
I heard you talk about collusion, you talk about bot trading against bot. This morning I read an article on Bloomberg, they quote that dumb AI bots, they collude. Have you heard that?
No.
It's a research on simulated trading environment. The professor, they make a two AI. They're supposed to compete to each other.
Then they figure out it's better to
Collude.
Okay.
and share the profit.
I think that's what economics 101 would typically predict, right? If you compete and then you die, then let's cooperate.
Yeah, it's quite interesting.
Okay.
By the way, I like these figures as well because it emphasizes that not all program trading are high frequency trading in Thailand, just a little bit of them. Maybe back to my slide, I show you some current issues or something I observe in the market that might be relevant to the market microstructure. Let's start with the issue, right? I started my job at the exchange just a few months before the COVID. I think it was the time that we have seen a lot of changing in the trading rules. And if you back to the concept of market microstructure, it is something to explain how the trade taking place, given the context of trading rules. Right. So you can recall this year we have a lot of market disruption event happening, the geopolitical volatility in the markets. So it's quite a good time for you guys, researchers, to think about it, to do research on this. We have changed the, from time to time, I recall during the COVID, we changed the circuit breaker rules. And this time, given the tariff thing, we have changed the selling floor sometime. We introduced a new trading rule about the dynamic price band for individual stock, getting more dynamic monitoring during the day. And sometimes we impose some short sale restriction. Sometimes we impose and then we just say this is temporary and back to the normal trading rules from time to time. The short sale, we do have both the limitation on price, we call the uptick rules, and sometimes we have some restriction on the universe of the stock that could be subject to the short selling. So if you think about market microstructure research, this is quite a good time to do research on
Yes.
on this changing of trading rules, and this as well. I think you guys are familiar with the trading in stock of Thailand, right? We have the cash balance measure, and it has been modified from time to time. And this year is quite big change for me. If the stock is too hot and we cannot calm it down, the measure getting more enhanced, so that eventually there will be auction market. Is quite something new, and actually just some stock just try this measure recently, right?
Switching from a normal open market trading to auction during some moments when things are getting a little bit out of hand.
Yeah, too hot to and some other additional measure to calm down the hot stock. I can recall that back to 10 or 15 years ago when we just introduced the cash balance measure, there is a research on these old measures, something like should we extend the period of cash balance from 3 months to 6 months, right? And I think the paper found that we don't need to extend the period of cash balance from 3 months to 6 months, because most of the stock could calm down within that 3-month period. But except some very, very hot stock that never calm down. For example, that way of doing research in this field. And for high frequency trading, this slide show you that it getting more and more participation from the program trading, right? The yellow one it start from 20-something to more than 30% in the market. But then again, as Khun Pongpit said, not all program trading are high-frequency trading, just small amount of them are high-frequency trading. But then again, we change something about trading rule for them as well. Try to limit them to high liquidity stock, for example. And okay. And on the other side, we try to promote retail participation into this technology, right?
You mentioned MT4, so
yes, you just
here we go,
mentioned
MT4.
about about that program. We have various programs to support the retail investor to do this technology. The simple one could be the conditional order, right? This is quite the most simple one. And after simulation and training workshop, that maybe something like this as well, this Rodman program.
That's right. I mean, I've only been involved in this recently, and I didn't. You know, I'm more of a low frequency researcher, right? I research things at an annual frequency or maybe monthly frequency. But the kind of questions, the kind of case studies you have to tackle, these are like, you know, tick by tick decisions you have to make. Like, you know, if other people this is what other people are selling right now, what do I do? Okay, and that's the world of trader. So it's great we get to experience things like this. So
again, as I mentioned, I would like to emphasize that all the measure and regulation got to be in this loop of thinking. They could be designed and they should be proportionate to the event, and then we need you guys to do the evaluation so we can redesign the thing to be in line with the situation. So this is kind of the principle that we think about when making the rules.
So now that you're on the page of the rules, I think we can probably go back to the point about rules again, because you know, from perspective, you're the one who's providing the venue for people to do what they want to do, they enjoy their experience, and then on the other hand, the SEC is like the referee, right, deciding what constitutes an offside, what constitutes a foul. So typically, when these decisions are being made, you know, if you don't want to answer it, then it's fine. But I'm curious to hear about the kind of you know, thought process behind typically global market developments. You know, we see things changing, we see markets offering new things and so on. What kind of consultations or what kind of a dialogue happens between the providers, okay, versus the rule setters to strike a balance with the, you know, changing landscape, like bots coming in and different types of orders coming in and so on?
We can get back to the principle, and of course we have to do things in consultation with all the stakeholders as well. But things could be dynamic. It's not written in the stone. We can change the rule if the thing change as well. So we have it got to be a continuous process to keep evaluating the effectiveness of the rule and the changing situation. We don't need to do the market disruption or month long, right? The event could be absorbed quickly. The market could price in everything in some time, but we need time for the market to digest the information. But once it seems to well digest that, then we don't need that kind of measure to be prolonged as well. So I think even the rules could be dynamic as well, and upon the situation they keep changing.
I agree with Khun Chatchai that when market equity change, the regulation of the rules should be changed too. For example, we talk about the spoofing. In the past, the manipulative behavior focused on the price manipulation, right? But after that, after the technological change, the manipulative behavior changed from the price manipulation to quote manipulation, which is the wrong order or the fake order, right? So regulation need to be changed. Right now, the current Security Act, the spoofing or the quote manipulation is illegal in Thailand. So everything can be changed according to the market situation. Yeah.
We keep emphasizing that when we classify things like algorithmic trading, high frequency trading, these are just tools, right? What really matters are strategies, and what strategies are, you know, fair, and what strategies are disruptive to the market. These are you know, lines that typically we draw when we compete. Okay, so I want to take this time to go back a little bit about to research again. We mentioned earlier about, you know, researching things and also dissemination. I want to field this question to Vithan. How do you typically balance between like proprietary research to generate your own trading ideas versus, you know, sharing out? What I have in mind is like hedge funds like AQR, for example, that have a really big involvement in academia. They publish papers in top finance journals, yet they run multi-billion-dollar hedge funds as well.
Well, I think the most typical way to do this is we have our proprietary model. We use it for a while, and we got another one already. Then we share the old one, the previous one. But for the AQR, I really like them because they not only researching, they also build tools for us traders. Like they do the open source a lot on the library that is used in the finance field.
The data library, and I think more recently they even posting their code on GitHub for people to replicate as well.
Yeah, they are very generous, and they're getting more popular. They earn more clients and they earn more talents. So that's more kind of their strategy.
Ask, like, they're being generous, but they can be generous with a purpose. So why do you think they were able to be that generous compared to maybe like more proprietary funds?
Because they are one of the most advanced fund in the world. Yeah, they got new one already. They share the old one.
They're only telling you a fraction of what they really know, right?
Only fraction. And even when I own academy too, right? When I teach very basic and concept and some of the tricks, but you need like 10 tricks all combined together to be a really successful one, something like that.
So these are small things that people don't tell you about, right? Maybe they publish a paper based on, that's picking stocks based on value work, but in reality they may have like 10 signals.
It's kind of, for me as a teacher, it's kind of impossible to tell the students all the things they have to do. They have to experience it, learn it a bit harsh, do it and fail and keep develop new things to overcome the problems again. There's like very minor tips and tricks along the way. Even for example, like doing the volatility. What is your decay rate? How long is your data and what is your model? And you need to understand things and react to the change really quickly.
It's like you publishing a cookbook, all the recipes, because you know that there's no way you can cook as well as me because I'm only telling you some of the things that.
It's like that. There's always details in every step. How you, like correlation, do you do the average correlation? Like in the bank, when I was in the bank.
Yeah, how do you do correlation?
Yeah,
actually, I'm curious.
The correlation. It's how many days. It depends on the situation. It depends, and that's first thing. And second, we do it in time series. And the third is we average it differently. It depends.
So all the kinds of things that academia would say, that doesn't converge, but who cares? It works. That kind of thing, right?
Yeah, it's kind of that.
Secret sources and so on. But that's from the practice side, right? We draw heavily on the research being published as inspiration from one another. But of course, the best ideas available are typically kept in their places until the time deserves before it comes out. But moving back from, say, market provider, okay, and maybe policy side, okay, how important or it is important, I guess, but how do you incorporate like academic research into your day-to-day operation as exchange provider or as a regulator? If I may ask Khun Pongpit to address that first.
Before I answer this question, I would like to add something about this. I just read the book, The Man Who Solved the Market. It's of Jim Simon, right? After finished reading that book, I don't know anything about his trading formula, but it's a funny book. Okay.
He never told anyone, right?
Yes, he didn't tell anyone about his magic formula. Okay. Also, go back to your question about how to utilize the academic research to day-to-day operation. As a research department, we read business journal, academic journal, and we consult with experts in the field and also with Ajahn who has a lot of knowledge about some specialized areas. So we get a lot of information from academic paper and business journal to conduct our own research. For example, when we study the pattern of algorithmic trading in Thailand, we don't know at the starting point, we don't know anything about the pattern of the trading behavior, but from our literature review, from a lot of academic paper, we can categorize the trading pattern into 2 or 4 or 5 patterns. We also listen to the YouTuber, but just for fun. but from reading academic paper, we know we gain a lot of knowledge to do our internal research on algorithmic trading. And when we explore deeper in spoofing behavior, we don't know anything about spoofing, but there are a lot of academic paper in leading market which study in depth about spoofing, so we can apply some of their concept into our own internal research.
So the work that you saw earlier, that was the work done internally by the SEC research team using the know-how from academia. Oh, by the way, if you have a research that you're interested in disseminating, okay, that's a SEC Capital Market Symposium that you can send your research papers for consideration for the award as well. And the deadline is 17th August. 17th August, okay,
yes.
Not very long from now. So
yes. You can visit SEC Facebook for more details. Thank you very much.
Yes. Okay, if I may move on to the stock exchange.
About the gap between academia and practitioner, right?
Yes, and how do you engage or utilize academic research in your exchange operation?
Actually, we have tried to bridge the gap between these two worlds for maybe 10 or 20 years of my humble experience. But luckily, I think the gap getting narrow, particularly in the field of market microstructure. It need heavy research as well, right? Back to what we have seen in the past 10 or 20 years about research in this field. I can summarize based on the data we provide, and we get the paper from the researcher working on our data. We have seen at least 3 fields that the researcher have done. The first is about the market mechanism. I can see familiar face here doing some paper here as well about how the volatility in the market, liquidity in the market, the interaction of the participant in the market, or sometimes there are some new instrument, how that it works in the market, how they operate in the market. That is the trading mechanism, the understanding of trading mechanism. The second one is about the investor behavior in the market, right? Sometimes we just confirm the end of day data with the intraday data. We could see the same behavioral bias in the market. We could see some mispricing, some arbitrage opportunity by using the intraday data as well. I can recall once we have just have the ETF on the Z50. There is a paper doing a mispricing between the 3 market, the stock of the 50 stock, the ETF and the future on the same underlying, that for example, the mispricing among the 3 markets with the intraday data. And lastly, about the regulation, about the market design or about the oversight. I can recall the paper about the cash balance effectiveness, the IPO profitability among the who got allotted on the primary market versus who trade on the secondary market, for example. And we have seen some technology when the researcher try to apply the deep learning models, try to analyze the order book and try to detect anomalies or manipulation in the market. That from the 10 or 15 years that I have seen the research in this field. Look ahead, I think a few things that we could see in the next 2 or 3 years could be, first of all, the new product, right? The new product. Before that, we have the derivative volume as a new product. We have ETF as a new product. This day, we have a digital asset as a new product. We have DR, depository receipt, as a new product, right? And a big thing we could have the carbon credit product. And in terms of market microstructure, you might help us think about what should be the contract size, how to trade, who should participate in the market. There are many question that you could answer in terms of market microstructure when we have new product landscape in the market. We may have G token as well.
Not for trading. Or maybe.
We don't know yet.
Okay.
And as I said, we have new technology these days, so I think could be different with your powerful analytical tool and access to new type of data with new technique, with the AI, with the NLP, large language model. You can access a huge set of data. That could be a few direction that I have seen.
Now that we're on the research, on topic of research, may I, take this opportunity to ask the other two panelists about the research topics or research fields that you think are interesting. This can be from your organizational point of view or your own personal point of view as well. Khun Vithan, what kind of research do you think has a lot of potential or you interested in right now?
It's definitely on the AI, but I will focus on the AI hallucination because we did a lot of system that is based on OpenAI. Say we do the agentic on even investing or even the marketing tech. I do it both because
so your educational work has been more on like building AI agents for trading recently, right?
We have both for AI agent for tradings and also for marketing. Like say if you can use AI to analyze what people think in terms of trading, you analyze is it will going up or down. Then it's the same that do you like this brand, this products? Do you like the founder, CEO, or something like that? So I'm on this, say, interest in this field. And the problem is that there's still some hallucination to me, like 1%, 2% is still always happening. And it needs a lot of measurements to, say, techniques to prevent the hallucination.
So for 1%, 2% for marketing might not be too big a deal, but 1%, 2% for trading.
It's too much. It's too much. Say we don't really know that 1% will be a huge loss
Maybe
or
that black
small
swan
loss.
that wipes everything out.
Yeah, it could happen. It could happen.
Yeah, thank you, Kap. And Pongpit, Kap, what kind of research topics maybe you're interested in right now and you want to feel this out?
Okay, I would like to add something on the AI in capital market. We just conduct the policy research for internal use about the adoption rate of AI in Thai capital market. What I could share is that the adoption rate of the market participant in the Thai market is quite high compared with other countries. For example, the Bank of England and FCA launched a survey maybe 3 years ago, and adoption rate is around 85%. We also launched the survey, and we found that in Thai market, the adoption rate of the market intermediaries in Thailand is around 81 or 82%, quite high. But if we look into more detail, it is quite interesting because the level of adoption, level of technology is quite basic. For example, they use just very, very, very basic algorithm or basic machine learning, or for more advanced applications such as the large language model. Almost all of market participants who apply the large language models into their work just use the Copilot or the ChatGPT, not developed by themselves. This is a challenging of the Thai capital market. The adoption rate is high, but the level of technology is quite simple. Go back to your question about the research topic. I think Khun Chatchai mentioned almost everything, but I would like to add on, as a regulator, I would like to add on just one topic on how to use the AI or machine learning technique to detect or to categorize the trading pattern in the Thai capital market, because it's extended to my work that use the algorithm but not machine learning. So if you have the expert in this field to use more advanced technology to detect trading pattern, it would be more useful to the market. Thank you.
Thank you. And this, we need like 128 core cloud processing, maybe half a year of time to process all that data. There was a paper by I think Eric Budish using data from London Stock Exchange, and they was looking at the competition between high frequency traders. They talk about microseconds competition between different high frequency traders. They only using I think a few weeks of data, but it took them 2 years to write that paper, and it took them like several days just to run the data with 128 core processor. So looks like we should buy up on all those companies that sell all the data infrastructures. I think maybe I want to open this up to potential questions. If you have questions you want to ask about, and then in the last few minutes I'll ask the recommendations for, we have lots of students here. So from your own personal recommendation, what kind of preparations you have so that they can prepare themselves for the job market? Maybe work at SET, SEC, or work as a trader. But at the moment, any questions from the floor? Oh yes, there's a question in the back. Do we have a mic to?
From the regulator point of view, I would like to ask what the penalty for the manipulative algorithm, and what if the developer doesn't mean or doesn't intend to manipulate? What is the line to separate the good bot and the bad bot? And what does regulator use or utilize technology to detect the bad bots? Thank you.
Looks like this direct at you, Pongpit. May I again reiterate the disclaimer of opinion that this is an academic opinion on the issue.
Thank you, Ajahn Kanis, and thank you for the question. First thing first, I would like to go to the fundamental that algorithmic trading is not good or bad by itself. It's just the technology that helps traders to execute or implement the order. So in regulatory perspective, we have a word called technology neutral, which means that at any kind of technology, we apply the same rule because we look at the fundamental of the underlying activity. So there is no penalty for algorithm because it is algorithm. But if the algorithm did or will do the bad thing in the future, it will be penalized by some rule. And what is the next question? It's about how much fine. It depends on the degree. It depends on the intention. It depends on the size of the activity.
Are we going to find the account owner? We're going to find the computer owner. My guess would be, the juristic identity that sends these orders, right? Because the regulations is written as technology agnostic. Once you see this behavior, then whoever sends that order is the one who's guilty of that. Hopefully that is the question. Any other questions from the floor, Kap?
So overall, do you think these algorithms are ultimately good for the market, or do you think that they should be rated more so that human traders have more of a hand in trading?
From our analysis, we found that most of trading activity in Thailand are execution algorithm, which is good to the market because it reduces the cost, minimize market impact. And for high frequency traders, most of them use the market making strategy. We try to provide liquidity to the market, and the result is that it's narrowed the bid-ask spread. This result is in line with other markets such as Japan and Netherlands. So I think in general it's quite good for the market, but we have to accept that there are some bad actors that regulator or the exchange might need to do something with that bad actors. Yes.
Thank you.
May I also ask Vithan to share his view on this as well as market participant?
I pretty think quite the same because the more robots is better because it's more efficient. To have like market makers always do their jobs, and the liquidity gap between the bid ask is always very narrow. So even human traders, they want to sell, they can just dump in.
I think internationally it's mostly algorithms against algorithms, like bot against bot already anyway. When I say against, I don't mean like, they're taking advantage of one another. It's just the counterparty tends to be machines. And this kind of maybe align with how the world works now. People say most of the traffic on the internet, they're bots anyway. So
Yeah, they're all bot.
We could make a movie about this.
yeah.
Even though like you said, arbitrage bot is trying to make the profits. It's doing the market making job too, because it helps things to become fair price.
You mentioned that they have directional versus non-directional strategy, and these are not directional, right? They just buy and sell, buy and sell.
Yes, exactly.
Okay, Kap. Thank you, Kap. Any other question? Yep.
I believe that these days the algorithm is being reviewed by some authorities for being deployed. I'm not sure, like, is it going to a broker and then going to the SEC, or where is it go to? Because the question is, how would we prevent the fund running when people see how the bot reacts? Like, for example, if I deploy like trend following or some particular algorithm, right, for trading, then that, like, I mean, the algorithm is being naked in front of like the people that I don't know. So how do I make sure that I'm not being fund run by the people who are reviewing the algorithm? What measures to prevent that?
Again, the disclaimer still applies.
It's quite lucky that in Thailand we have only one stop exchange. So the fund running by traders is not in that case. But if you work in the financial intermediaries and you were the financial consultant or the stockbroker, and you know your client order and you send the order before your client, or you were the fund manager and you send the order before your fund, that would be the absolutely fund running. But you send the order by you don't know anything and you just send the fast order. I don't think it would call the fund running. It's just a fast order. Yes.
I think we agree on the terminology, because front running typically comes from the US discussion where we can buy the same thing in multiple places. So that is front running, right? But maybe your question is more about, if I know your algorithm, I know how it works, so I can find the countermeasures, or I can even fool your algorithm. I think this is one of the areas where I talk to a lot of people who are in engineering, doing machine learning, and they say that this is a bigger class concern. Okay, you talk about the bot killers. That's basically other bots trying to figure out what you do, and then once your strategy is known, they find countermeasure. It's like a war between different robots. There are even discussions about, once you have machine learning models, how do you make sure your machine learning model isn't compromised? So going back to your question, if you have to review algorithms, then it sounds like, you have to give people your secret recipe. So it's back to the people doing the checking, that they can provide that confidence to the people who are being regulated, that those secrets don't leak. But even the bigger scheme of things, even if you don't have to tell other people about your algorithm, the concern about your algorithm being targeted in this new trading environment, I think is an area I hear a lot of academics talk about as well nowadays.
I could add on this, because when you submit your algos to broker, right, you don't need to provide all the logic details. It's just a brief concept level details, high level details, yeah. Because any algos we have the minor details in like parameter setup and like the latency, everything, say everything.
Have a bit of faith, otherwise we end up into like Jane Street and Millennium Capital case.
But the Jane Street, they ask that is HFT, say is a mispriced, something like that. But obviously it's not. It's not.
So won't go down that rabbit hole today because still case being considered right now. So in the last few moments, I think maybe I'll ask each of the participants to talk to the students about what kind of preparations they can do if they want to succeed and excel in the today's finance and trading landscape. May I start with you?
All right. So my advice is when you study things like the risk test setup and all like the strategies, try to look back as long as much as possible. Say like when I study about the cycles, I try to go back as far as possible, like 200 years. I did it already, 200 years. As it depends on your data, right? It depends on your data. But if your data is just price or daily, or like you use of factors, try to, when you have one data that frequency is daily and another one as monthly, never interpolate the monthly into daily. That's another advice. Right, I give you two. Right.
In short, I think we need the computational knowledge because from regulatory viewpoint, from the early day, the traditional regulation just use the legal and paperwork to enforcement. But right now we use the combination of knowledge because we need the people who know data analytics and also know some basic legal, Thai legal. And when we also need a lawyer who can do some basic analysis. That's all. That's my recommendation. Yeah.
Is your team hiring?
Yes. Great for you to talk to me.
I think you guys don't need any advice. You're already here on the right track to the financial markets already. So I'm glad to see this kind of competition and happy to support this kind of forum again. Thank you.
And this brings us to the end of the panel. Please give our panelists a round of applause. And may I hand the stage back to the MCs.
Thank you very much, Gav. Such a wonderful session to conclude the academic and research portion for the events today. And at this point, I would like to extend a heartfelt thank you all for including the audience, the professors, and our distinguished guest speakers too. And your support has been invaluable, and we hope you guys enjoy the session. For non-competing participants, you are kindly asked to leave for the next session, which will be for our competing participants tomorrow. For competing participants, please stay seated. Thank you very much for today. I hope we see you again next event we have